What is a QQQ put option? Have you ever wondered how investors can profit when stock prices fall? One way they do this is through put options, specifically QQQ put options. So, what exactly is a QQQ put option? A QQQ put option is a financial contract that gives the holder the right, but not the obligation, to sell shares of the Invesco QQQ Trust at a predetermined price, known as the strike price, within a specific time frame before the option expires. The QQQ is an exchange-traded fund that tracks the Nasdaq 100 index, which includes 100 of the largest non-financial companies listed on the Nasdaq stock market. Let's break this down a bit. A put option grants the right to sell an underlying asset at the strike price. This is different from a call option, which gives the right to buy. Investors typically use put options when they expect the price of the underlying asset to decline. Now, what is the underlying asset in this case? The QQQ exchange-traded fund represents a basket of Nasdaq 100 stocks. The prices of QQQ options fluctuate in response to changes in the market price of QQQ shares. Investors buy QQQ put options mainly for two reasons. First, they may want to speculate and profit from an anticipated decline in the price of QQQ shares. If the price falls below the strike price before expiration, the put option increases in value. Second, they might use put options for hedging. This means protecting an existing portfolio of QQQ shares against potential losses. The put option acts like insurance, limiting downside risk. Here's how it works in practice. Suppose an investor buys a QQQ put option with a strike price of $405 and an expiration date in December. If the QQQ price falls below $405, the investor can either sell the put option at a profit or exercise the option to sell QQQ shares at $405, even if the market price is lower. The maximum loss for the put buyer is limited to the premium paid for the option. Several factors affect the pricing of a QQQ put option. The current price of QQQ relative to the strike price is key. Time remaining until expiration also plays a role, as time decay reduces the option's value as expiration approaches. Volatility of QQQ shares is another factor. Higher volatility generally increases option premiums. Interest rates and dividends may also have minor effects. For a practical example, imagine an investor holds a portfolio worth $110,000 in QQQ shares and fears a market downturn. They might buy QQQ put options to hedge. For instance, paying a premium of about $4,428 for puts with a strike price near the current QQQ price can protect most of the portfolio's value if QQQ declines. The break-even point for profitability on the puts would be the strike price minus the premium paid per share. In summary, a QQQ put option is a derivative contract used in stock trading and options strategies that provides the right to sell QQQ shares at a set price before expiration. It serves as a tool for speculation on price declines or as a hedge to manage downside risk in Nasdaq 100 related investments.